Okay, welcome back to Not Financial Advice. Today we're going to be taking a look at a really neat stock, a stock that I think is definitely a stealth sleeper stock brought to my attention by one of our subscribers. So thank you so much for that. I'm glad that I'm able to have a chance to get around to this as I've had some rough stuff going on in the family. So I appreciate your patience. I'd also appreciate if you would like and subscribe to this video as I bring you this informative content. So today we're talking about Eurofins Scientific. All right. And so right off the bat, let's notice that this stock is down almost 51% from all-time highs. Um, and let's look at a description of who this company is. So Eurofins Scientific SE is a French group of laboratories headquartered in Luxembourg, providing testing and support services to the pharmaceutical, food, environmental, agri-science, and consumer products industries and to governments. So they are a laboratory, a collection of laboratories, um, medical tech. I think med tech or med science would be the right broad category to have them in. But essentially, they're a pretty dominant European scientific laboratory testing corporation that tests everything for anyone. And so this is a company described by Morningstar as having a narrow economic moat, which means that Morningstar doesn't feel as if this business is at any threat of being knocked off for at least 9, 10 years. That's what a narrow moat with Morningstar indicates. So they're down 61% from all time highs. Um, I have been informed that this company played a big role in the response to COVID in Europe back in 2020 and 2021, etc. And my understanding, what I've been informed by others, is that, and it makes sense to me that this is one of the first companies uh, that was able to produce testing. They were able to produce testing because they had laboratories and they have synergies and laboratories at scale. Um, and so, this is one that reminds me of TMO, Thermo Fisher Scientific, which I've done a video on as well. And just taking a look at the trend line on this stock, we can see there's times when it's probably been undervalued and overvalued, and we may have a reason to believe that this stock is undervalued. So let's go over to Qualtrim, and I'm going to ask you again, make sure that you've liked the video and subscribed to the channel. I sure appreciate it. But today, what we're doing is we're not going to be as much worried about what the price of this $59 stock is. So that's where the stock's currently trading, $59. We want to get a better idea of what this $59 stock, which is down 61% from its all-time highs, we want to get an idea of what this stock is worth on a per share basis. So as always, we're at Qualtrim. It's a suite of software that I pay for, but one that I'm not affiliated with. And we're going to start today by looking at some metrics that matter. So follow along with me. Not all of the data is available on Qualtrim from European or international stocks, but we still have some data here that we can see that's important. And so they have a reasonable ratio of cash to debt. Looks like they have about 4 times as much debt as they do cash, but they're sitting on a significant amount of cash as of the recentness of that metric, of that figure there. Another thing, we're going to go over to Google to find this important financial metric. So this company is essentially a small large cap company. So in the past, they were certainly a large cap company, but that 61% price decline has put them on the verge of being considered a mid cap company. Their market capitalization has gone down quite a bit, and that's a pretty significant drawdown. The question is whether it was warranted or not. So $59 stock. Let's come over here and figure out what this what this thing is worth. So we have those metrics. We're looking at a smaller large cap stock at this point. Not a horrible cash and debt situation, a nice free cash flow yield of over 4%. And we're going to go through all of our checklist to see if this is an investment worth considering. So I was blown away by this, the revenue growth on this company. So over the last 10 years, they've grown revenues at 20.4% or 20.5% over the last 10 years. Year on year on year on year, they've grown revenue at 20.5%. And so, with the pandemic, I was wondering, what would happen if I sort of went back to 2019 and the 5 years prior to that. I ran the numbers, deleting, this jump that we've seen from here to here, but the numbers going from 2019 back to 2015 or whatever, that was still at about 17%. And so this is a company that's not overly old. This company was started in 1986. So I think you know, the company as a you have to take my word for it. You'll be able to see it on the screen here in a moment. But the company being, only a 35-year-old company is, I think, on its lifespan of being a company. I think it's in its teenage years. I think there's a lot of growth ahead of this company. With this lower market capitalization, there's, I think, a lot of growth that can be expected from this company. And so let's keep in mind this 10-year growth rate of 20.5%. And that's what we're going to be using in our discounted cash flow rough valuation to get an idea of the range of this stock. But fantastic growth on this company. It's a check mark. Let's take a look at the free cash flow of the company and pretend those 2 years aren't there. What I do when I do my rough DCF is I go ahead and I average the free cash flow from 5 years, and I think that paints a emblematic picture. But even if we go back, so 2022 to 2012. In 2012, you had $60 million in free cash flow. 10 years later, $340 million of free cash flow. So this cash flow is up and to the right, and it's as of recent times, it's been parabolic. Even this jump here from 180 to 340, a doubling in 4 years. Very, very, very strong free cash flow growth. So the free cash flow is growing at about 19% a year. That's absolutely fantastic. All right. So that's going to be a check mark on free cash flow. Um, we talked briefly about the cash and debt. So put it as a check mark. Doesn't look overly alarming. So now let's take a look at this company. Apparently, they're paying a dividend. I'm not sure how much I agree with that. And the dividend's growing really fast. I guess they're paying a dividend. I didn't anticipate that, so I didn't check for that. So this is a live action blooper. Well, I'm trying to figure out how to get you the information on the dividend. Go ahead and like the video, subscribe to the channel. Yeah, with the company so far and with what I've seen just preparing for this video, that's fascinating. A 2% dividend yield. It's pretty cool. Um, so a 2% dividend yield, just do a payout ratio. Payout ratio of 49.5%. I have another source here saying it's 40%. So some of the times the problem with researching stocks, another place saying it's 32%. Um, let's go with Morningstar. Another source saying the payout ratio is 46%. Let's see what Morningstar says. I think the payout ratio is somewhere around 40%. That's sustainable. It's a sustainable payout ratio. Okay, Morningstar is showing Eurofins scientific payout ratio to be historically at only 22%. So there's a lot of dividend growth in this company. This is actually really exciting. If you feel excited, like the video, subscribe to the channel, sure appreciate it. So it's about 44% payout ratio at 2%. That's a excellent dividend on a company with such significant revenue growth and free cash flow growth. So that the debt looks okay, the payout ratio isn't crazy. Check mark on that dividend, a surprise check mark. Let's take another look at things that matter. So shares outstanding. This isn't the end of the world, but it's an X. They're they're issuing shares. Not this isn't too terrible. I mean, I guess their price really spiked and they've had a track record of issuing shares. So I don't love that. That is an X mark for the company. Let's not even dwell on it. So let's see what their ability is. Eurofins here, this European, very dominant laboratory medical science testing company. Let's see what their profit margins are. So go back to 2012, they had a profit margin of 6.3%. Now they have a profit margin of 9%. So their profit margin is growing. It's a check mark. Return on capital employed, it's pretty flat. Seems like an average of around 10% on return on capital employed. This is going to be a neutral. It's not great. It's not bad. Now let's take a look at another thing. Maybe I had a mini stroke, or maybe we just forgot it. Profit margin, bottom line profit margin. Okay, so it's growing, but their bottom line profit margin is around an average of 7 to 9%. I wish it was a little bit higher. And so one thing that I would look out for on a company like this that has a lot of machinery and science and technology, huge and growing amounts of capital expenditures. So in fiscal year 2022, they spent something like 660 million euros on capital expenditure. At least they have a decent return on capital employed. So we know that this is a company that's compounding to a respectable extent. Um, and then that's where we can see some of this debt. So it'd be an interest rate sensitive company. They spent more on capital expenditures than they received in free cash flow for fiscal year uh, 2022. So as far as another test, which we always could consider, is this a capital light company? No, it's an X. This is a very capital intensive company. Um, let's do one last thing and just see how their revenue did during recessions. Um, so 2002 is the first year we have $161 million in revenue in 2002. The next year, 2003, when the tech crisis and 9/11 recession ended, they still had revenue growth. Let's go from 2007, see how they're doing in recession as part of a recession portfolio. 491 million in 2007, 491, 2011, almost 2x, 823. 2018 was like a rough year for the US markets. They grew in 2020. So this is going to be a check mark for top line revenue during recessions. So I'm really liking the look of this company here. Let's take a look at where they've traded on a historic price to earnings valuation. They're trading at a 10-year low at a 22 current PE. It seems like. Um, I think that's a great PE for a company with this level of growth. Okay, so this is absolutely fantastic. You can take a look at this if you care to. I explained how they test anything and everything for everyone, a European based company, but also a company that is worldwide to an extent. And so I'll just leave it there for a second. If you want to pause the video so you can just sort of take in this. I'm going to ask you to like the video and subscribe to the channel if you haven't already. But before we look at this is your chance to pause if you want to finish reading this description. Before we finish finding out what the value of um, Eurofins, I believe $59 stock is, I guess I would say, it's a $59 stock. Do I understand what they do generally? Yes. Do I understand the nuance of what they do? Not at all. Do I understand enough to invest in this? Maybe. Maybe. Um, Science is a thing, medicine is a thing, regulations are a thing. Different parts of society produce, buy, trade, or consume in products which need to be tested. A lot of this revenue is probably going to be a regulatory requirement of the European Union or various governments that certain products are tested or certified to an extent. I think this looks like a pretty safe company. And so if I own this and it went down 61%, would I have freaked out? I personally don't think that I would. But if you feel confused by what you paused and read there, you might not want to buy this company. Um, Not financial advice. $59 stock. Let's get an idea of the value on this company. So we'll go right over here. Um, you can check my math on this, but I think this was their. I made sure to convert everything from euros to US dollars. I leaned on Qualtrim with their data being right. Um, Nothing looked out of line, so you may need to double check that. But I everything looks right to me. I did go ahead and double check the conversion. There was a conversion, I believe, on their amount of cash on hand, which I pulled from this tab here. So just to sort of show my work here, give you the receipts. I converted everything from euros into US dollars for this valuation. $59 stock. We remember that we had that growth rate of 20.5% revenue growth over the last 10 years. I've used some really conservative assumptions based on the age of this company and the market capitalization of this company. I've I feel it's a conservative estimate. Additionally, based on this here. So, because I'm not an expert in this area, I wanted to get an idea of what the projected future, growth rate of uh, diagnostic testing is, and so different sources are saying around 8 or 9%. But I'm just showing a lot stronger revenue growth in this company, apples to apples. So, they're growing at 21%. Um, Economists are saying this market should grow at 9%. I split the difference and I feel that's conservative. But, valuations are just educated guesses. So, $59 company, we have the average free cash flow over the last 5 years of 482 billion. Total cash on hand 528 billion. Excuse me, that's going to be 482 million dollars in cash. Excuse me for the last time. An average free cash flow on an annual basis of $482 million. Last 5 years, free cash flow $482 million per year. Current cash on hand, a war chest of $528 million. Total debt is going to be 2.8 billion US dollars. Shares outstanding 200 million. Growth rates that I've inputted based on those things that I've shown you and discussed is 15% over the next 5 years, years 6 to 10 at 12.5% with a terminal growth rate of 3%. I think the discount rate of 10 is appropriate. So $59 stock is worth $68, I believe. Big old bell, confetti, check mark. This looks like a very attractive potential investment. So if you enjoyed this video, make sure to hit like and subscribe on the video and channel on the way out, and I will see you in the next one.